Orlando, great to have you join us. A conversation a long time in coming. Let me just start off with the spate of deals itself. You know, I had the opportunity to look at the proxy for a number of them and the background of the transaction. You often had competition, maybe other PE firms or even a strategic, and you paid the highest price. And I'm just wondering, did you see something perhaps when it comes to these companies that others didn't, given a willingness to pay the highest price?
Well, David, first of all, thank you for having me, especially since I've always been a big fan of your show. I appreciate that question. There are two things at play for Thoma Bravo. First and foremost, we're doing these deals because executives and founders want to work with us, because they like to work with us. We have put together a unique strategy over 20 years in buying 300 software companies that is based on providing operational improvements and accelerated revenue growth to these businesses, but at the same time seeking to do that only with existing management, empowering the innovator and the visionary. That's why in some of these deals, they're proprietary deals with a go shop later. In the deals where we have had competition, yes, we have seen something different in those businesses. What is most important to us is not the purchase price that we pay, is what we are going to do with the company going forward. And software is a great space for the opportunity to improve companies. Think about it. There's over $1 trillion market cap in SaaS software. And on average, the public companies are not profitable. So they're big, big opportunities, and we bring those to bear.
Right. And I get that. And listen, the returns you brought to your investors have been very strong. One reason why you've had so much success and grown your assets under management, I think, eightfold in a relatively short amount of time. But let me get to the math on the Medallia deal, Orlando. You know, you buy it at something like, I think it was around 10 times revenues. It's got a very significant growth rate, over 20% on those revenues. But it would seem that you still need a revenue multiple of roughly 10 or 11 times on your exit a number of years from now to maintain the kinds of returns that your investors have become accustomed to. Am I wrong in assuming that you are assuming exit multiples will remain where they are right now?
Okay, so I will stay away, because we're national TV, from talking about a specific deal that is still a public company that has been announced. Now, what I can tell you in general, okay, if you want to define it in one sentence, what we can do operationally in partnership with those innovators and with existing management is as follows. We seek to turn revenue multiples into EBITDA multiples 4 years later, based on accelerating the organic growth of the company, improving margins significantly, and then using that balance sheet capacity that comes from both to make add-on acquisitions for that business. And we make our returns on a fundamental basis based on an exit level of free cash flow, which we believe is where these companies ultimately trade.
Right. So you trade a revenue multiple for an EBITDA multiple on exit that you assume is going to be fairly high, given your ability to, as you say, help transform these companies. What gives you the confidence, though, right now? Orlando, we all know there's a great deal of liquidity around. You know, we can point to a period like this sometimes years later and say, wow, things got really out of hand. What gives you the sense that they're not out of hand right now when it comes to the multiples you're willing to pay?
Oh, these companies, this is the best time to be in enterprise software. About 10 years ago, it became very clear that the world was going to SaaS and to cloud computing. And with that trend that we've been on for a period of time, the budgets of companies, of enterprises, opened up, because if you can rent these products and you can procure them through the cloud, you don't need your internal infrastructure. It opens the company up to consume these products much easier. At the same time, the industry started producing solutions that approach very large or target very large markets. Now, through the pandemic in the last couple of years, it seems like the whole world decided at once, all these industries, that they were going to accelerate their transition towards going digital, accelerate their digital transformation plans. So these companies have a long, long runway for internal growth. And the key is, it's not their ability to innovate. It's not the end market, because those are very good across software segments, is their ability to execute. And that's what we're here to help them with.